Hello everyone, today is the 17th of August 2026 and I'm dropping this quick update because several important things are coming up this week that will significantly influence not only crude oil but also precious metals, stocks and other markets. First, today is the crude oil futures options expiration at the New York Mercantile Exchange. At 2:30 p.m. Eastern Time, roughly 470,000 put options and 365,000 call options will expire. After expiration, a much smaller and relatively balanced position in the US crude oil futures options market will be left. This tells us the market isn't taking a very strong view on oil momentum right now, differently from the recent past when positioning was often one-sided on the bearish side. Interestingly, this big expiration happens exactly as the truce between US and Iran ends because the 60-day MOU agreement will expire. Will the option expiration occurring at the same time as the MOU expiration unpin a large chunk of the crude oil market? For sure, the risk of broader military confrontation in the Middle East will rise after the MOU expiration. But don't worry too much yet because next Friday is also a key date for financial markets. On Friday, August 21st, we have the monthly US options expiration when massive volumes of equity, index, and ETF options expire. The reason why I'm pretty sure the US government wants to limit the risk of triggering any market volatility this week. So this week, the Middle East military situation might likely stay constrained to what we're used to. That means IRGC hitting oil tankers trying to cross the Strait of Hormuz without their consent, or Houthis attacking Saudi ships in the Red Sea or Aramco oil facilities. What I've described aligns with the broad volatility set up across markets. Crude oil volatility remains elevated, but the VIX and other measures suggest calm. The former is now even trading at the lowest level so far this year. Traders seem confident that the US government, which wants markets to keep rising no matter what, will be able to insulate markets from anything that could upset the upward momentum. That's why I think Scott Bessent's potential new sanctions on Iran, due to be announced this week, will likely be all fanfare, crafted to crush oil prices while leaving everything else in markets unbothered, pleasing everyone who wants markets to stay well managed and public. But why worry if everything is so carefully controlled and protected? As anticipated to my premium subscribers on slides last week, one variable doesn't benefit from global financial stability. That variable is Iran, which could surely exploit market turmoil in its quest to weaken President Donald Trump. We have seen signals from Iran's supreme leader over the past several days about military commanders being told to shift from purely defensive to offensive postures. This means potential offensive actions against neighboring countries hosting military assets, considering a threat to increase Iran's territorial security. If Iran goes down this route for real, not just as a negotiating technique, I believe Iran will act carefully to avoid pulling in other US allies, like the UK or France, in the region. If those countries join, significant military reinforcements might not bode well for Iran, but a well-planned action could spike volatility in an incredibly fragile market and global financial system. We know this giant house of cards is actively protected from any blow of wind. This is why Iran could achieve significant financial market damage with just a small move, strong enough to scare traders and break the convincing yet fake narrative used so far to keep them calm. Obviously, market turmoil would increase pressure on President Trump ahead of the midterm elections. If a volatility event sparks in the current circumstances, I believe it won't be short-lived market fear or something similar to what we experienced in March with big liquidity shifts. If you are interested in accessing my premium analysis and commentaries, like the one I just published on silver miners, practical tutorials on option trading, or in joining my community and interacting directly with me in our group chats, you will find the link to subscribe to my slides portal in the description of this video. So, what will happen in case Iran successfully triggers a market turmoil? I'm afraid, but I believe safe haven assets like US treasuries, gold, and silver might suffer as well initially. Treasury yields are already at the highest level since 2008 financial crisis, and a further weakening from this level, while the total US public debt is about to cross 40 trillion US dollar milestone, will surely create way more headaches for Trump and Biden to deal with. The picture for gold and silver is different at the moment and pleases me as a silver and gold bug. But as I explained last week, this move isn't truly driven by strong genuine demand for the physical metals. It is more speculative demand for paper contracts tied to Fed rate hike pattern expectation. At this point, I'm sure many of you are asking themselves if this week the US government will do everything they can do to avoid market volatility. What about next week? Starting next week with OPEX out of the way, the probability of a US military action increases significantly, but I believe they'll wait until the long Labor Day weekend in September. Why? After today's WTI crude oil option expiration, they likely wait for Brent crude oil option and future expiration at month end. Then 88 hours of closed US markets could be the perfect window to act. They might try a swift, powerful strike against Iran during that closure. But I wouldn't hold my breath for that strike to succeed. If that strike fails, Iran's retaliation could escalate the conflict. But let's not forget that preparations for a big attack might even trigger a preemptive strike by Iran. To conclude, be ready for an increase, if not a spike, of market volatility in the following weeks. Don't assume the status quo, where markets remain greatly detached from the geopolitical and economic reality, will continue forever. The financial market might seem perfect, but things in the real world are worsening. Ultimately, the two must converge, and the bigger the gap, the more dramatic the snapback to equilibrium. Thanks for listening to my podcast today. If you don't want to miss a future update and support my channel, like the video, subscribe, and turn on the notification. Thanks for subscribing as well to my premium content on Slice, for supporting me on X, and for reading my research on justdario.com. I wish everyone a nice day. Bye.